Fund Supermart, your online gateway to unit trusts.
What is the outlook for Asia for second half of 2015? What catalysts do you see for the year?
Okay, we think Asia has been quite challenging. The basic economic fundamentals of Asia, we have seen quite a lot of slowdown across the region. The experience that we are feeling in Malaysia, for example, slowing consumer confidence, weaker corporate profit outlook, and general property market which are quite flat, it's pretty much reflected across the Asia Pacific region. So for example, countries like Indonesia, Thailand, even Philippines and Singapore and China are facing a similar situation in terms of growth outlook and in terms of corporate profitability. When we look at stock markets, it's driven by two main things, right? One is the economic fundamentals, which we said it's generally slowing across the region. What investors are looking for is more monetary easing across the board by the respective countries and of course from a global perspective. So when we look at individual markets, we think those markets which have the more positive government support tends to be the ones in China and potentially in Singapore as well. Whereas the countries like into Thailand, Indonesia, Philippines, Malaysia, the public sector leadership is not as strong as desired to be able to bring investors back to drive the markets up. So we find those markets to be a bit more difficult to invest for the next 6 months.
How much further upside is there for investors, and are valuations and earnings outlook appealing?
Okay, let me maybe just start with Malaysia first. I think the Malaysian market has been flat to down in the large cap space. I think the small cap space is still a bit of year to date is still up about maybe 5+%. If the current situation continues, which is the current situation being a lot of noise coming out from the politics, we don't think there'll be much upside in the Malaysian market, right? Because the political situation is making investors extremely wary of investing in Malaysia, and a lot of them are staying away as a result. For there to be upside, it's conditional on improvement in the political situation, which is, to be honest, anybody's guess. But our base case is there'll be no change currently, so there'll be a drag in terms of the situation for the Malaysian market. Likewise, for countries like Philippines, which is slowing down, they are going through election next year. It's unlikely that the public sector can come in to drive positive change in the economy, which is needed to arrest the slowing GDP growth, because they'll be quite busy going for the political run. So we do not see much upside for the market there as well. Philippines as an economy is still healthy. The risk is that the valuations are very expensive, and it's a very small market which can be subjected to foreign selling, which makes the door very small when people try to get out. So it tends to be affected by foreign flows quite a lot. It's a similar situation in Indonesia, slowing corporate growth, property market not going much. There was a lot of expectations built in earlier for the new government to make changes, but it turned out that they have not made as much changes as desired. In fact, they have made a lot of policy changes which were adverse to the listed companies. They have made a lot of populist policies which are detrimental to some of the way market functions properly. So unless we see a big change in that, investors will unlikely to be rushing back into Indonesia as well. Third one is Thailand. I think very clear that one is being dragged on even further. We have record low in terms of foreign shareholding in Thailand. Consumer confidence is collapsing. Foreign direct investments, foreign portfolio investments are low because there's just no desire to invest in a country which is run by military ruling. So unless we see some changes in that, we don't expect much upside from there. I suppose the other market I haven't really addressed is on China, I think, which is very topical currently. China, there's two key markets. The larger market is the A-share market, which is a domestic market that has gone through a bubble situation, and that bubble has collapsed in the last about 3 weeks and is still collapsing currently. That has effectively wiped out a few trillion in terms of US dollars of wealth of the Chinese economy, and it has also taken down the H share market, which is where most international investors and people like us invest. So the key question is, can the government action currently, which is being promoted almost on a weekly basis, can they reverse the massive slide that is being seen in the A share market? Our stance is that the government policy that has come out so far has actually made some of the things worse for investors and is causing some of the massive sell down that we see across both H share and A share market. For example, they have suspended up to 30 to 40% of the stocks traded in the A share market. They have stopped the margin selling of shares, which is not allowing the clearing of that, and this is causing some panic among some of the portfolios which are forced to liquidate the other positions in the H share market because their position cannot clear in the A share. Is creating more panic than intended in the H share market. The H share market and the A share market is currently very much flow driven. There's a lot of shorting activity going on by hedge funds. In terms of fundamentals, it's slightly circular in the sense that the market is huge. The amount of wealth being wiped out is huge. If it continues at this stage, if it doesn't reverse course, the market downturn will have a knock-on effect on the real economy. It's like the tail wagging the dog, so that the wealth destruction could have a knock-on effect onto the property market, which is already quite weak, which can have a knock-on effect on the banking system, which is very leveraged to the property space in China. So all this circular downward spiral is causing the big sell down in the H and A share market, and it is still not clear whether the government policy can reverse the course. But we do note that the government of China are very determined to try to stem this correction, and they do still have a lot of firepower to do so.
What do you think is the key to success in terms of investing in Asia?
To be successful investing in Asia, there are quite a few things we need to be good at. Asia is not one big continent or one big country. It's made up of many different cultures and many different unique opportunities. When we invest in Asia, we definitely need to have ears on the ground, people on the ground, to understand the local condition, because a lot of the markets are driven by local perspective. It cannot be looked at from one philosophy fitting the whole Asia Pacific. So we need people which is tuned into the individual Asian countries, to be able to understand the local conditions. Secondly, I think we need to be very flexible in our views. We need to have conviction, obviously, but very often we find that the conviction can be challenged and can be changed quite rapidly, given how fast conditions change within Asia, within the individual countries. So the ability to change our conviction in a very quick manner is important to be able to adapt to the new trend or the new market condition. The other key criteria that we find that is important in investing in Asia is to have very succinct and very quick decision making, because trends do change quite fast, and if we are slow to the game, we can underperform as a result, even though we are right eventually.
What are the investment opportunities do you see in Asia?
I think the biggest core and the biggest view we need to get right currently is our view on China. Our view on China has a big impact on commodities, on the head share market obviously, which offers a lot of upside if you get it right, on major currency movements like the ringgit, like the Australian dollar. If you can get that right, if you can get our view on China right, we think it's one of the bigger investment opportunity for multiple asset classes. The other investment themes that we like within Asia Pacific is spread across. I think we like the Asian plantation space. I think the investor positioning in plantation has been quite light, and most of them have not really given up on the sector, but have not very bullish on this sector. I think what could change in the short term is what we call the El Nino, which is the changing weather pattern. By most studies, we are seeing that El Nino is happening, and if there is going to be intense or even a moderate El Nino, we should be able to see a shortage of production, resulting in driving up of the CPO price, and therefore the plantation stocks. And slightly longer term, I think the structural changes in the Indonesian plantation planting could create a slower growth profile for Indonesian plantation for the next 3-4 years. For example, things like NGO activity, making them more stringent to the environment, restriction on foreign ownership, restriction on the size of the plantation. Those have basically slowed down the planting for the last couple of years, which will be reflected in slower output growth for the next couple of years, which, if demand holds up obviously, that would generate production shortage, and therefore the price will be firmer for the CPO. I think one other opportunity that we like is in Singapore. We think Singapore is one of the countries, one of the property market that has slowed down first. And given that this is the 50th anniversary of Singapore independence and next year is the election, we would expect the Singapore government to start to loosen the property space, which is an important component of the economy. Also because the Sing economy has been quite sluggish, their monetary policy follows US. If you expect US interest rates to go up, the Sing interest rates will continue to go up there, and they would need to loosen some of the policies within the economy to reflate the economy. So we think the property space could be one of the key segments that they will start loosening the policies, and as a result, Sing property developers, which are trading at 30 to 40% discount to their breakup value, offers a pretty good risk and return in terms of investment opportunity.